Hello and welcome everybody to the 2021 year in review. And this year we're doing it with a combined State of the Union address, with Maverick Trading and Maverick Currencies. That's one thing we're going to talk about a little bit more. But at the end of the year, we did rename Maverick FX to Maverick Currencies to reflect the fact that we are now trading cryptos. And we have a really good crypto section right now. So I'm joined today by Rob, Imre, and Ankit, and let's get started here. As I said, we changed the name to from Maverick FX to Maverick Currencies. We've done some major upgrades to the websites, and what we wanted to do was give our traders more functionality and more resources. And I think we've accomplished that. We're going to continue to move on. We've got new templates that we're going to transition our curriculum over to, and also the midweek updates in the trading rooms. For both currencies and stock and options. The good thing is we had the second best year of trader profits. It was really good to see. Our traders did a very, very good job of managing their risk. Trader payouts were excellent as well. I'd see them come through, see the requests come in, and was really smiling when Rob and I were writing those checks, actually pressing buttons, but you get the point. And the number of profitable traders was very good. I think with this environment, risk management has really come through, and it's been reflected in the way that our traders trade. When we really appreciate that. You're taking measured risk, defined rewards, you're clipping profits when you should, you're letting your winners run. So thank you to everyone right there.
And Darren, let me jump in and just say that, second best year brings you like, oh, geez, we didn't break the record. Well, last year was insane. Last year was by far the best year for the firm. This year was phenomenal. It just wasn't quite as good as last year. So I want to take my hat off to all of our traders. Great job, everyone. We're super happy. And as Darren said, there's nothing we like better than sending out trader payouts. That's like my favorite part. And my favorite part is sending out the first trader payout. I love to send out the first trader payout because that's when it's real. That's when you're making money as a professional trader for a firm. So thank you so much, everyone. All right, before we jump right into it, one of the things, and this is something that I love to do, is I love to make predictions. And let me tell you why. Because I literally don't care if I'm wrong or not. And I understand that making a prediction in January for an entire year of trading it's a fool's errand. It's not even going to be anywhere close to accurate because so many things happen during a year. I mean, just look at 2021 when we had, again, the COVID, going crazy. And I actually was reading through these predictions and I had forgotten about things. And I'm like, oh yeah, last January, we were dealing with another COVID wave, worse than the first. It was the worst COVID had ever been. And then this year we had another surge right at the end of the year. So I make these predictions and I just forget about them because I react to market action. But it is fun to pull them out and see how accurate they were. So here are the 2021 predictions. We said, hey, we think the economy and the equity markets are going to have a good, solid year. So we said U.S. markets up around 10, 15%. U.S. markets were actually up 23% for the S&P, 19% for the Dow, 21% for the NASDAQ. So I'm going to go ahead and say, no, I can't give this an A+ because the markets did better, but I'd say I give that a solid B. The international markets do better. Well, guess what? That was a D. International markets did not do better than the U.S. this year. We talked about this was the year of inflation. So yes, we saw a bunch of inflation. That was a great call on that one. But look, that was a no-brainer call to call for inflation. Literally a no-brainer when $9 trillion more dollars have been put into the economy. And that was just in the U.S. So when we were looking at central banks, our call was that the central banks weren't going to do anything this year except talk. And for the most part, that's all we got. The Bank of England actually raised interest rates in December. That was the only, I guess that we had the Reserve Bank of New Zealand raise rates as well. But other than that, central banks literally did nothing. So we had the FOMC tries to keep the market soothed, and that's literally what we got. We got the, hey, everyone, we got this under control. Inflation is transitory. Don't worry, don't worry. And then by the end of the year, people started to worry. We call for a strong economic rebound in the second half of the year. Now, this was the one that surprised me because I was thinking, wait a second, why would we call for a strong rebound in the second half of the year? Like last year, the economy was good pretty much all year. And I had to go back to, oh yeah, we did this in the 1st of January and things were kind of shutting down again. There was panic and we're saying, hey, it's probably going to get a lot worse and then we're going to get a recovery. So, the economy did well pretty much all year in spite of the Delta wave and in spite of the Omicron wave. On our currency side, we called for strength in the Aussie and Kiwi to outperform. Absolutely wrong. These two currencies were middle of the pack. The yen was the weakest currency, so we got the yen right, but not the strength in the Aussie and Kiwi. And then this was another one, number 7. U.S. and China don't make progress on trade talks. And I was scratching my head thinking, what? Why would we write that? It was a thing. It was in the news as a thing, completely forgotten in every way, shape, or form. No one's worried about the trade talks with China. That's gone completely. So, true, they did not make any more progress. But again, looking back a year later, it's like, oh, why do we even write that? And then we've got commodity prices rise with inflation. Oil rising up to 75. That was a nice call. Gold to stay stronger. Gold did not stay stronger. Gold basically went nowhere. And we said cryptos were going to be volatile, but they were going to become an alternative to gold. And I'm really proud of that call because I think that's what's happening. The money that used to go into the gold market is really going into cryptos at this point. So overall, I'd give this a solid B minus. Guess what? None of it matters. The year's over. It's always fun to take a look back and see, what actually happened. So let's take a look at equity performance. And we take a look, we see S&P 500 up 26%. Let's take a look at the chart here. And you can see the chart is basically a very strong uptrend. And we had a few moments during the year where we saw some distress. We saw a little bit of distress here in February and March. We had some pretty decent sized pullbacks. These were decent sized pullbacks. We got a little bit in May, but the real pain came in September, October. That's where the real pain came. And then we got a really nice breakout of this bull flag pattern. So it was a very nice, we were watching this one when it broke out. A lot of our traders got really back on the long side. Had a great October, November, and then right around Thanksgiving, we got the Omicron wave and just had big volatility by the end of the year. Just really big volatility. So these were 4% moves that we were getting on a weekly basis. Markets finally broke out at the end of the year, but we talked about this was the last week of the year, low volume, low volatility, low participation. And we said, don't trust this. And sure enough, we've sunk back down here in January. So when you take a look at this chart, it's just an uptrend. There's nothing you can say other than, okay, there was an ABC correction here. But other than that, this was just a really, really strong year to the upside. So if we go back, let's take a look at the NASDAQ, and we'll see that the NASDAQ wasn't quite as strong. Still uptrend, no question about it, but its dips were a little bit bigger, and it just lagged a little bit. This was the first year the NASDAQ underperformed the S&P since 2005. 2005. So we've had almost 2 decades of tech outperforming regular stocks, and this was the first time since 2005 that it did it. But it was still a good, solid year. Let's take a look at the sector performance. So best sector last year was energy. Energy had a nice run. Oil was up big, so energy was up big. Tech did really well, and real estate were the shining stars here. Consumer lagged. This one actually surprised me quite a bit when I looked at the numbers because the consumer sector had a really nice run in the September, like the end of summer to November. but it definitely underperformed outside of that. So that was an underperformer along with utilities as well. So we want to take a look at everything. There was a lot of strength in materials, coal, gas, shipping, all nicely. And the weird thing was there was a lot of weakness in the metals. So it's a very strange thing when we talk about inflation. Typically, the metals have been the hedge against inflation. Gold, silver did not go up last year. They actually went down. So where is the hunt? Where is the safety for inflation going? And as I said earlier, I think it's going into the crypto market. I want to check last into the emerging market sector because this was our call, is that the international emerging market sector did better. And you can see this is the EEM. It was abysmal. The performance was absolutely terrible, down close to 10% on the year. So if we take a look around the world and we say, okay, well, where were the returns? Well, if we take a look at North America, nice solid returns. The Mexico market actually went up more than the US market and the Canadian market. We go over to Europe, you can see that it wasn't as good, except for Norway at 58%. And the best performing stock market this year was Greece. That was over 100% for the year. But pretty much Europe saw less. It just saw less growth, less opportunity. So you can see everything there was around 10%. And then we work our way east and we come over to Asia. And Asia was ugly this year. China down 40%. That is a real serious drop. That's a huge drop. That's a 2008 style drop that China experienced. South Korea down 17%. These are really nasty numbers. Singapore down 4%. And the markets that actually could eke out a gain, they could eke out no more than 10%. So when you take a look at where the returns were, North America was the best. Europe second best. And Asia was hit and miss, and mostly miss, and sometimes really bad. So that was what happened in 2021. So let's talk about our outlook for 2022. Now, we talked before this session, and we wanted to, I don't want to say get on the same page, because we're all traders and we all have different opinions, and we are completely okay with dissenting opinions. And we all actually debated quite a bit. What about this? What about this? And in the end, we all kind of realized that we were on the same page. We think this market's going to be struggling this year. And I know Darren pointed out 2015 as a model year, where in 2015 we had two 10% pullbacks and ended the year flat. I would not be surprised at all to see that. I think we are in this situation where the Fed is pulling back. Other countries are pulling back their stimulus. Interest rates are going higher. The easy free money is no longer going out there in the market. Now look, they're not taking it out yet, but the froth is likely coming off this market, and the market's going to struggle with that. So I think the regular stocks, the stuff like the General Electrics and the Fords and the Cloroxes, those are going to be ho-hum good stocks. They're going to do their thing. They're going to go up 5 to 10% a year, and it's going to be a nice solid year for them. However, in the world of high growth, and I'm just going to use the term high beta stocks, these are the stocks that don't have profits yet, that are still depending on the ability to raise capital in order to fund their operations. These stocks are likely going to be where they get hurt. And I've got down below the bubble pops. Now, we've been talking all of 2021 with our traders. I remember the first week we did the trading room, I put up a slide that says, are we creating a bubble? And I put that slide up about every other week for the entire year. And the message was always the same. Yes, we are absolutely building a bubble, and the bubble isn't done building yet. So at some point we said it's going to pop. We know it's going to pop. It's already getting deflated. So this isn't as far as a call goes, this is not the top. The bubble's been getting let out for about the last 2 to 3 months, especially on, the hot at-home stocks like Zoom and Peloton. Those have already given up. But we think this year is the year that those kind of companies struggle. And we're going to start to see venture capital dry up. We're going to see some companies actually fail by the end of this year. So because of that, I think you've got two things going on in this market. You've got the average stock chugging along, doing its thing. The economy's growing at whatever, 0, 2%, 1%, whatever it is. And they're going to do fine because they've done fine for 40, 50 years. You've got that side of the market, which is just going to trot on and probably have a average year at best. And then you've got this other area of the market that's going to be volatile, and it's going to have some shakeouts, and it's going to have some serious selling. And the big question is, can the regular stock, the Bristol Myers, can it weather if Peloton crashes and goes down another 80%? And not just Peloton, but all the other stocks. Can it weather that? So I actually think that is the struggle this year, is that do the stocks that were in the bubble, if they deflate, does that become contagious and cause all the other stocks to go down? Darren, what's your call on that?
Yeah, I'm similar to you, and I think one of the key points on this is that venture capital drying up. We have to be in a rising interest rate environment. We don't have to be, but with the Fed, we expect the Fed to raise rates. All of us do. That makes it difficult for emerging companies that are pre-IPO, to fund what's been going on for 25 years, fund a series of losing years as they grow market share. I think those days are done. And the only thing that's going to get funded by large venture capital firms is going to be something that surprisingly actually is turning a profit pre-IPO. And that's not been the case since probably 1995, 1997. What I do see, I also see the potential for some M&A activity. But it's not going to be at the premiums that we saw 10 years ago. You're going to be right. It's going to be companies that have been downtrodden, that maybe have a core business that is still good, but they've put out too many feelers. They've gone too far afield of what actually makes money, and I can see some M&A activity when they get into trouble. Possibly more on the private equity side than actual leverage buyouts. Don't want to be doing leverage buyouts in a high interest rate environment. We learned that in the 80s. So I definitely see that to be the case. But how do you want to call it, fast tech? I think people are going to be looking at that with a very leery eye, and I absolutely agree with you. I think I think industrials are going to be doing well, but if they've got overseas exposure. So I think that's what we're going to be looking at as well. I guess the easiest way to put it is it's the type of market that did well in the early 80s, I think is what's going to be good. So I'm more bearish on this right now. So I'm of the opinion that we get 0 to 2% growth, and that inflation runs 5 to 7%. And I think if we get much past 7%, I don't think that the Fed will not be able to act. We might get more activity than what the market is happy with. And I think that's one of the real risks right here. So the other things that are going on, we still have supply chain constraints, and you're starting to see it in grocery stores, where you go and there will be an empty shelf in the middle that just didn't get that the order just didn't come in. I saw that today. I had to go to the store, and the pet aisle, the pet toy aisle, was completely picked over. There was nothing there. So it seems like a small thing, but I think supply chain constraints are going to be an issue. Hopefully, we don't have another catastrophe like the Suez Canal getting blocked earlier in the year. Shortages due to COVID. We're going to have to learn how to run our supply chain in this environment, and there's going to be some times. But I think that happens throughout Q1, and then from there the supply chain should be good.
Hey, Darren, on
You
the
know,
Suez Canal blockage, I agree. I would hate to see that happen again, but the memes were amazing.
were awesome. They were excellent.
I'm not saying it made it worth it, but holy cow, those were some great memes.
Transitory inflation. This is where the Fed is finally getting to the point where they're being more open. As you can say, the Fed spent the first 9 months, inflation's transitory. It's going to increase. Transitory is kind of, permanent right now. It's not gone down. And one thing that I don't think is fully reflected in the inflation numbers is rents. We've seen large increases in real estate prices, especially in the residential market. But with in the U.S., where we had eviction moratoriums that are now coming off, people are now they're beginning to be evicted. They're going to take that opportunity. The owners are going to take that opportunity because they've not had, in some cases, people paying rent for well over a year. They're going to try to make some of that back, and they're also going to have to take a look at where the rates go. If they've got a floating rate loan, they have to cover their costs. So that's another thing. I don't think rents are fully priced in. So that's one thing that is going to be good. I do think the real estate sector is going to slow down in new construction just because it's going to be more expensive. But I think we take a look at rents. If those start being reflected, then we'll see the true nature of inflation, and that could be higher than what we expected it to be. In September, the FOMC announced the taper of asset purchases, and they're beginning the reduction in November. This is something they have to do. It's not quite. It was the easiest tool they had. They didn't want to raise rates. Let's take away some of this, some of these asset purchases, and that will, help the inflation, hopefully. And finally, the FOMC admits that inflation is here to stay, and they increased the rate of taper. And I think that shocked a lot of people that we knew it was coming. They didn't expect it to be as bad as what it was. But I think that best quote right there is the transitory nature of transitory inflation. I mean, that is the type of doublespeak that the Fed has to tread that very thin line of knowing that interest rates have to go up, but not wanting to spook the markets. So I'm glad that I'm not there. And you can see that the bond prices, this has been reflected, really throughout the year. You see the beginning of the year on all of Q1, rates went up naturally on their own. Pulled back about halfway in through August, but now they're back up nearly to where they were in the later parts of Q1. And I think that's going to go. I mean, I would not be surprised to see the 10-year bond at 2% plus within the first 6 months of the year. I think that's where we're going to have to go.
And Darren, I want to just point out that this low of the summer of August, if there was one surprise for me of this entire year, is that we got back down to really low bond yields for really no reason. And this to me was just crazy that we are back down to these lows when the stock market was making new all-time highs at the moment. Typically, these move inversely from each other, and they just tended to go up, which just means that there was so much money out there chasing too few assets that everything went up in value. And so you can see that made a huge reversal in August. And this is a really big increase. Now, if you look at it, from where we started the year at, not that big of a deal, but this increase we saw in the fall is very, very substantial. So I know we have Imre here, and Imre is a guy I go to for interest rates. Imre, what's your take on interest rates going forward here?
Hey, Rob. Glad to be part of this conversation. So I think interest rates are really interesting because to me, it's historically been a tug of war between the market and the Fed. Now, I look at interest rates probably a little bit differently than how most of you have heard interest rates explained on CNBC or other sources of mainstream financial media. In my opinion, it's not really the Fed that sets interest rates. Like, yes, it is the Fed that says, we're raising or lowering our lending rate to this or that. But if you look at the price action in bond yields, you'll notice a really interesting trend, which is that the market leads the Fed. And I've seen this play out historically and also in real time in more recent years with financial markets, where a rising yield will prompt the Fed to act, 6 to 8 months down the line, or vice versa, falling yield as well. Of course, yields have been in what seems like a perpetual, or have been in a perpetual bear market. And I think that we're now very close to breaking that bear market cycle in the yields. Does that mean we're going to see, a runaway 10-year yield, at 10%, 20%? No, that's not going to be the case, at least not for next year. But I do think there is the possibility that we're going to see the market demand that the 10-year be priced substantially higher from where it is. As Darren said, potentially 2% plus very quickly. And then the question is the Fed going to act? And I think the Fed does have an out here. If the market cools off, if the market sells off substantially, then the Fed does have an out. They don't necessarily have to follow the market. And then we're going to see that tug of war kind of take place. And it's going to be a very interesting battle to see how these risk assets get repriced. Because I would say right now, if you look at the market and you look at discounted cash flows and discounted future earnings, et cetera, I don't think the NASDAQ is priced appropriately given how fierce the climb in the 10-year yield has been. So is that going to continue to be the case? I don't think so. I think we are going to see a fairly substantial repricing in those high growth stocks. And the NASDAQ is going to be a great way to keep an eye on that market action as a whole, of course. But it's going to be really, really interesting. I definitely would not want to be in Powell's shoes. I think he's crazy for accepting this renomination. If I was him, I would have gone out on a high and retired. But yeah, we'll see what happens.
Hey, thanks, Emery. Great words. Right, let's check in on commodities real quick. We always like to take a look at commodities because there's so many strings tied in the market. And what I mean by that is correlations. When oil goes higher, it pulls up energy prices. It pulls up a lot of other asset classes. And when, gold goes lower, it pulls down asset classes and pulls up currencies. So we always like to keep an eye on commodities, not necessarily to trade them, but to have a greater understanding of the correlations and the push and pulls of the market. So if you take a look at the performance, really the industrial materials did very, very well. So we're talking about lumber, oil, steel, copper. What didn't do well was the precious metals, the things that people buy for hedges of inflation. Those underperformed. So if you take a look, crude oil really just had a great year all year long. I mean, just very strong from the beginning. Had a big run all through August, pulled back a little bit, had a monster run August through September, cooled off, and early January right back up into the 80s of where the market is. So oil had a nice run pretty much all year, which is why we saw the energy sector as the best. If we take a look at gold just didn't go anywhere. Had a big fall first part of the year and then just didn't really go anywhere. So really between the 1700 to 1900 range, I think gold is pinned there. And all the reasons why people used to buy gold. Again, people used to buy gold as a hedge of inflation, and because they were worried about the value of their currency. And especially when you go to countries in Southeast Asia where they've had a lot of devaluations, people don't trust the currency. And so what they do is they own metals because they don't trust the currency's value. Well, crypto has really started to take that away from why people buy metals, is that people have more trust in these decentralized cryptocurrencies than they do in the metal. So gold, I think gold is going to be pinned here. And if we take a look at copper here, copper had a nice run early in the year and just flatlined for the rest of the year, basically setting a base. So if you take a look at a lot of the industrial commodities, things that are used for building things, you'll see the same thing. Big runs of the first part of the year, bases for the second half. That's really setting up nicely for a run into 2022. So 2022 is basically the same of what we saw in 2021 with commodities. We think anything that's used for building and growth does well. So oil, I don't think we're going to see over $100 a barrel. We still have a lot of supply, but the demand is there, and OPEC is definitely working together with their members to keep oil higher. So I think we're going to continue to see oil higher. We are likely to see nat gas fall. This is more just seasonality. We're done for the year, so nat gas is going to go down. We're probably going to get a spike in the fall. Gold and silver, I just don't like it. I just don't like this trade whatsoever, because what is the impetus? Everything that gold and silver stood for happened last year. Everything, the massive printing of money, the massive stimulus, the massive supposedly devaluation of the dollar. All of those things were reasons why people bought gold and silver, and they didn't. So that's just a sign to me that, hey, that trade is broken. And I think it's the cryptocurrencies who had a fantastic year is where the money went. So I think gold and silver, I don't think you waste your time anymore. The industrial metals are going to be great, and I really like the rare earth metals. Things are going to be used for the next wave of EV vehicles and battery technology. Those are in short demand. Hey, Yonka, do you want to run us through Forex?
Definitely. Hello, everyone. It's always fun to be part of this year-end review. And yeah, 2021 was quite a year in the FX market and the global markets. But I would say that 2021 was a year where we noticed the FX were really started to deviate from the overall correlation in the market. So we don't see a big numbers as far as the percentage goes, but we did see a lot of movements that happened. You know, we have the Aussie and the Kiwi, like Aussie standing there negative for the year, but we started off on a very strong note. So 2021 was just a sideways year for a lot of these currency baskets, as we can look at it. Yeah, was not a whole lot of movements that we can see as far as the trend goes. So it was a good year, steady movements, not a whole lot of volatility. But yeah, one of the mindset that we have to shift from was the correlation, because there were a lot of time in distress where we could have seen certain currencies really act up, like the Japanese yen usually shoots up when there's a distress in the market, but we didn't really see that happen. And this is where it really caught a lot of traders off guard, because if you are trading based on those correlation, you want to sometime act ahead or trade in a way where the global markets are heading. But this is definitely not that happen. But this is one of the reasons why we pay attention to the relative strength and weakness. That really came in very handy in 2021, because overall we just have to mute out what was going on in the markets and just focus on what the currency is doing and follow that trend. But the dollar was a surprising movement, because we started off on a negative note, but then we started to recover. And remember, at the same time when the markets were actually making new highs as well, but the dollar started to kind of go up with the markets as well. So we started off with the negative correlation to a positive correlation. The Japanese yen, on the other hand, it started off on a negative note. It did follow the dollar the same time around in the summertime, but then took us down back to near lows for the end of the year. So the yen overall felt that it was more in line with what the global markets are doing, where there was a up move in the markets, and those are the times when we see the yen do actually not the best. But outside of that, there were some currencies like Swiss franc that didn't make sense. It deviated quite a bit if you compare with the euro. There was a big correlation that really broke down in between those two currencies, and we usually don't see that. And remember, there have been times when those currencies were uncorrelated from each other, and then that's where the Swiss franc was really at a risk with those Swiss bank interventions, and we did see those actions took place. But yeah, we started off on a positive correlation, and then we actually deviated from that. So overall sideways movement in the euro, but we had a nice direction in the Swiss franc, which is something we'll talk about going into this year. Outside of those, if we take a look at the risk currencies, so typically when you see the markets go up 20%, you want to see the growth currencies do really well as well. But look at the Aussie. Aussie was down, and we started off on a positive note, especially after having a stellar year of 2020. That was the best currency of 2020. So nothing really changed in the markets, but we did notice the Aussie started to lose the ground. And then same thing with the Kiwi. We haven't gone anywhere in the Kiwi for the entire year. That's phenomenal for the Kiwi because of the market conditions. And we had the RBNZ that did come out and raise the benchmark rates as well. So that's quite a surprise out of the Kiwi as well. And if you look at Canadian dollar has been actually rising. And if you look at Canadian dollar, 2020, it was almost trading like the way the Kiwi was. It didn't really go anywhere, and then it certainly started to pick up. And then if we take a look at pound, lastly, the pound has been kind of going nowhere for the past few years, and here we are now touching 2016 highs. I mean, this thing has started to come out and start to break out or push these boundaries that we really haven't broken. So that's another theme that we noticed in 2021 is some of these currencies that have been range bound for years is now pushing those key resistance and support levels. So I think 2022 was a great year where we could potentially see those levels get lifted, and that's where we'll see some bigger moves come into the markets. So overall, we did talk about the market potentials and we talked about correlation, but I think overall, if depending on where we are looking at markets, but Aussie, Kiwi, and pound overall, I think we're likely to do better. And then if you look at the dollar, I know dollar is the one that I was really questioning because we have the FOMC that's likely to raise rates. So there's always a question how the dollar is going to react. But again, if they're raising rates, dollar is not really rallying off of that. So I think we really have to pay attention to not what we think, but what the baskets are telling us. And so far, we're not really seeing that kind of enthusiasm, even though they're looking to raise these benchmark rates. Canadian dollar, I know we have a neutral on that one as well. I think it's very much tied to the U.S. dollar. In the past year or two, we've seen that these two currencies kind of deviate from each other from time to time, but overall, they're kind of anchored together. And then euro, which hasn't really broken out, I don't think 2022 would be the year because they're still very, the least hawkish central bank out there. So I think euro likely to stay where they are. And if the market stays positive, I think the yen likely to continue that trend to the downside. And Swiss franc is the one that is a big shift because we have seen Swiss franc rising. And so we are taking a call that, well, Swiss franc could reprice to the downside. And again, we'll probably keep an eye out on that whole euro Swiss franc benchmark rate as well, because that's if it gets below a certain critical level, that's when you start to get Swiss banks start to get involved in this forex market to control that. So I think this is where we could see some repricing happening in Swiss franc. But again, these are all arbitrary outlook again throughout 2022. I think these things will go back and forth, and that's why it's fun to talk about. But I think throughout the year we'll see good opportunities in all of these currencies, especially as we break out of those resistance levels and support levels that we haven't broken out for years. So that'll make it an exciting 2022. All right, back to you, Rob.
So the crypto market this year was kind of on fire. And, we look at these monster gains in like Ethereum 400%, Cardano 600%, and then we look over at Bitcoin and it only did a pitiful 60% for the year. I mean, that is just pitiful. So big gains across the board. And if we would have closed these numbers out in August, these were all up substantially more. They sold off the last 2 months of the year. And so some of the highlights in the crypto world, Coinbase goes public, Bitcoin and Ethereum ETF. So there's now ETFs that the regular investor can buy to participate in. NFTs, let's not even get into NFTs, but that is definitely a new asset class that we've seen. And the market really, really grew quite a bit. So, Imre, what is your outlook here? And we'll take a look through some charts on crypto this year, or at least what happened last year.
Yeah, in a word, Rob, I think it's awesome that Interactive Brokers is starting to offer crypto trading, and that we're able to start offering that to our traders as well as we head into 2022. The reason I think it's so awesome is because I think crypto is going to be an excellent trading market, emphasis on trading market. I think there are going to be some volatile swings back and forth. Ultimately, it looks like the decline that's in place right now is probably set to continue. So, Rob and I were talking about Bitcoin, all of us were, and yeah, I think our general consensus is that we might see some big bullish swings, but that downtrend is really going to stay intact. And if we look at some fundamental reasons why, well, that cheap money that we were talking about earlier is drying up. And as it dries up, that has a whole series of knock-on effects. It's not just that free money had to circulate somewhere and that crypto was as good a landing place for that money as anywhere else. It goes beyond that. If you look at what it means for that money to dry up with interest rates going up, it means that the cost to service debt is going to rise. And when the cost of servicing that debt rises, people will, well, they'll suddenly notice that despite the fact Bitcoin might be accepted as legal tender in some places, you probably can't pay your mortgage in crypto. So people will liquidate. They'll liquidate as the cost of servicing that debt becomes higher and higher and higher. That's just one interesting knock-on effect, I think, of the broader macroeconomic picture and how it's going to affect asset classes like crypto. On a technical basis, we can see that we're trading below some really important moving averages on some pretty high time frames as well. So we're looking at a big picture snapshot here, and that's pretty much for crypto across the board. Now, obviously, not all cryptos are created equal. There is, I guess, what I'll refer to as quality, and then there is quite literally some dog crap cryptos. Our Shiba Inus and our Dogecoins and so on. Those cryptos, I think the days where people are going to find tiny little altcoins and pump their life savings into it in the hopes of becoming an overnight gajillionaire, that trend might continue in the retail crowd for a little bit. But I really do think this is now going to become a trader's market, and professional traders are going to do well. I can't tell you how many times I've gone back and forth with Ankit where, we've talked about the current market environment and how it's a great environment for amateurs where all you had to do was kind of buy and hold various asset classes, crypto definitely among them, and smart money finds that challenging. We can find that very difficult to trade at times when things just seem to keep going and going and going in one direction. Well, it looks like those days, at least for the foreseeable intermediate term future, are over. And that means we're going to see those swings. And that means we're going to have opportunities to take advantage of these movements both up and down. So even though we don't have access to margin to trade crypto, if we have fairly large intraday swings, that can still be worth capturing. So I think crypto is going to be a very exciting development for our traders. Hopefully it leads us to some big payouts. But overall, I think it's going to be a very, very dicey year for crypto markets.
And Imre, let me just take something you said and make that the theme of 2022. What you just said, that last year was an easy year for amateurs. And this year is going to be a much harder year for amateurs. And when you said that, I thought that's what the theme should have been for this whole session that we're doing, is that this year is going to be tough. There's going to be opportunities. It's not an easy ride. It's not, hey, there's some new stupid coin with a dog on it, and literally you buy it and you end up tripling or even more of your money. Like that literally happened. We had the meme stocks back in the first of the year, and people just buying and just holding, and it just went up, buying GME, GameStop, and it just goes to 300. And they were right. They were right because they got on a chat board and bought it, and they made a bunch of money, which I love. But that's not going to happen this year. And that's one of the reasons I also agree with your outlook on crypto, is that the reason it went up a lot was because of I'm just going to use the term dumb money. And as it gets harder and harder and harder, I think the dumb money is going to say, hey, either I'm going to lose my money, or they're going to say, I'm too scared to do anything at this point. So I definitely agree with your outlook that it's going to be a rough year. And thank you. That is like the theme of this session, is that it's going to be a harder year next year. And that people that know what they're doing, they're going to shine. And the people that didn't put in the time and effort and they just bought whatever they read on Reddit, it's not going to be a good year for them. All right, so let's kind of wrap this up. Sorry, go ahead, Darren.
I also think this year is going to be one of those years where you, to do well, I think you're going to have to become a multi-asset class trader if you're not already. I think you're going to have to, we're used to preaching find strength and weakness, and we're still going to do that, but there's going to be some periods where you either it's too volatile or it's dead money in one particular instrument, and in order to get any type of performance, you're going to have to go to other instruments out there. I think this would be, if you're thinking about taking a look at if you're in one division and thinking about taking a look at another, I think this is the year to do it, because there might be periods of time where nothing is going on, or it's too wild to trade, and you look for something else. I know, when I'm doing my daily routine, I'm taking a look at those other markets, and that's kept me out of dead money for a lot of times, and it's put me into things that are actually moving in a predictable pattern. So I think that's what you're going to find with a lot of retail traders. If they don't evolve into that multi-asset class trader, if they don't become the smart money, there's going to be a lot of retail traders get hurt.
And Darren, that's so true. I've already probably about a dozen traders have reached out to me in our stock and options side when we made the announcement that we're going to be trading currencies, and they said, "Hey, you know what? I want to broaden my horizons. I want to be able to trade more asset classes." So, yeah, I think this is the year that you need to know what you're doing. You absolutely need to know what you're doing. And look, I know it's frustrating, and I remember talking to Ankit, and Ankit's a disciplined trader. He's been doing this since 2009, and he had friends of his that were literally buying Shiba Inu, and they made a bunch of money, and they're like, "Why aren't you doing this? I thought you were a trader." And it's hard. It's hard when that is going on to not want to lash out. Well, don't lash out, but you know what I mean. You stay disciplined as a trader. This is the year that it's going to be much more difficult for those people. And for you, if you simply know what you're doing and you know how to handle currencies and you know how to handle cryptos and you understand how to do, again, options on everything, all of a sudden you can really position yourself this year. So wrap this up. We think it's going to be a rough year. Go ahead.
Well, can I love what you said. I just wanted to drive this point home because I just last week I spent a long time writing. I write a little blog in my corner of the internet, and I wrote about exactly this. And the question that I get asked every time my family around holidays is, isn't trading just like gambling? What's the difference? How are they similar? And I really thought about that this year, and I came up with probably the best answer to that question that I could ever come up with. And it sums up, I think, the difference between the last 2 years and what I think 2022 is going to bring very well. And so here's my answer. What's the difference between gambling and professional trading? The answer is that the gamblers are amateurs. They look for the exceptional. the Shiba Inus, the GameStops. They look for those moonshots, the 1 in a billion things that have, the lowest odds of working out. Professional traders look for the probable. Okay, so yeah, some folks have made overnight fortunes in the market. For every one of those lucky guys, countless others have lost everything by playing the exact same trade, but maybe they got in too late or too early, right? See, this is why casinos will always be popular. It's all about that chance you might strike it rich if it's your lucky night, okay? The house always wins. With markets, however, professional traders have a distinct edge, and they'll only trade when that edge is present. And that is what allows them to pull profits consistently from the market. And this is key, I can't emphasize this enough, over a long period of time. Now, your edge could be whatever. It could be a strategy, it could be a chart pattern, it could be a bunch of indicators that tell you when to take a trade. It doesn't matter what your edge is. The important thing is that you can recognize your edge when it's there, and then you have the emotional discipline to only trade when your edge is present. I can't state this, I can't emphasize this enough. I think that is going to be the one thing that's going to keep you out of trouble in 2022, because there are going to be a lot of volatile swings intraday. We're seeing that already. And if you don't know what you're doing, you're going to lose your shirt. So stay disciplined, stick to your trading plans, and 2022 might be that record-setting year for the firm.
And I hate to say this, but this is finally going to be the year that you can tell all your friends who have been gambling like crazy, I told you so. Now look, don't say that. For any of you who have been married or in a relationship, those are the words that we all want to say, but you can't ever say it because it ruins the relationship. So just keep it all inside, keep it all bottled, and just feel good about your performance. I've had a lot of times where I've given people warnings in my life, and in 2021, I looked kind of dumb in some of them. I wouldn't buy that. I wouldn't touch that. And it was a phenomenal trade. This is the year that you're going to finally be right.
So let's wrap this up, and I appreciate everyone coming here. So 2022 at Maverick, we're going to continue to add great traders. We're going to do that in a measured pace, so that we're getting the right people at the right times, bringing them through the qualification program, and then letting them trade our capital. I mean, that's a core part of our business. We're going to keep doing that. We're unfortunately not going to be having a spring summit due to the COVID situation. I know we had one last year. Things were looking a little bit better. We were looking at having it in a different city this year. The way things were, though, if travel becomes restricted for whatever reason, it could leave a lot of our traders in a bad position. We didn't want to do that. One of the things that we're really happy to talk about is the addition of the Psychology Corner in the websites. That's got some videos, some handouts, and really that's one thing we wanted to focus on. We've got the technicals down, and where we wanted to build out the curriculum and just the assets for our traders to use was in the trading psychology. And because that's where a lot of people have their problems. They can be technically a very good trader, but it's when you add that element of live capital to the situation where the chemicals in your brain take over. We want to teach our traders how to not combat it, but live with it, understand yourself, understand your strengths, your weaknesses, your tendencies, how you react to certain situations. So I'm really happy that we added that Psychology Corner in there. And we're also going to be expanding our multimedia and social media presence. And we looked at that and said we need to make a shift to bring us up to where things are. We looked at a lot of our curriculum, and it was too static. So we're taking a look at adding additional interaction. We want to make everything that we provide to be quality. We want it to be compelling. We want it to capture your attention. And we might be looking at some shorter types of videos as well. So that template is being rolled out in the end-of-day videos in the trading rooms that we're going to be going with, and we want to put our content out there so that more people can get to understand what we do. Even if they don't decide to trade with us, we want them to develop a little bit of an edge in the market so that they don't get hurt, especially in years like this. So we appreciate everything that you guys do as our traders. We talk about this constantly. Our traders, we feel, are our best asset at the firm. We couldn't do what we do without you, so thank you very much. And here's to a fantastic 22. Thanks a lot, everyone. Oh, one more plug on social media. You can find our YouTube channels, Maverick Trading and Maverick Currencies. On Facebook, we're Maverick Trading. Instagram, we're at Maverick Trading, and Twitter, we're at Maverick Trading. So we've got those down. If you want to follow us, you'd be able to share some of our content with some of your friends who are interested in trading. That's the way to do it. Thanks a lot, everyone.